Hello traders, welcome back to a new video. Now in this one I'm going to be talking about the fractal nature of the markets, but a bit more in depth. Right now, the reason why I like to want to explain this video is because it just helps you get a better understanding of the why, I guess you could say, right? So pretty much fractal markets is pretty simple to understand. It's a simple concept, and it's just understanding how the market moves, right? So as you can see, we've got three different lines on here. They're not obviously the most straightest or whatever, but it just gives you a general idea, and then I'll show you some examples on what I mean. So as you can see, we've got the daily time frame here, which is obviously this green line, which is just moving pretty much A, B, C, D, E, F, G, right, and so on. And it's just going up and down, up and down, up and down, pretty straight right in price. Now if you trade from those certain time frames, the time frame would be pretty simple, right? Because the price just moves in pretty much one direction. Now, as you can see, if you go to the H4, which is just sort of turned down opacity yellow, you can see here that we starting to see more swing points in the markets, right? And you can probably start to understand that why it's important to look for breaker structures, etc. When you look at your trades from your supply demand zones. In this case, for example, supply zone, right? And then obviously if you move on to the 15-minute time frame, you can see that we have this yellow line, which is just like, so many swing points. It's super madness on the lower time frames. Prices are swinging all about over the place. And as you can see, even though it's moving in the same direction overall as the daily, because that's why the high time frame to look at the day time frame is important, to look at the structure and sort of have a directional bias and direction in which price is heading in. But as you can see, it's probably it's very self-explanatory, right? But as you can see, right, if we were to follow this in terms of looking for trades, there's you can short-term swing trade off these potential demand zones, counter-trend trade, or not swing trade, sorry, and then you can you can catch these short-term buys because we understand the fractal nature of the markets. So when price is obviously moving in this way, why not counter-trend trade? Because we're not on the right side of the market in terms of long term, but short term we are, because we can expect a pullback. Okay, and this is why, if obviously in terms of targets, you usually get most of the previous low and high. And if you're counter trend trading, a rule of thumb is to, let's say for example you got a buy from here after this breaker structure, you'd always look to target the midpoint of that previous impulsive leg that you measured the Fibonacci from, right? And you can just target the 50%. So yeah, if you can just look at this and just take it in, it is a very highly powerful concept, because pretty much, right, as you can see, we have these high time frame supply zones, and usually when you have market a high time frame supply zone, you usually drop to the lower time frame to look for a confirmation entry, and a confirmation entry is something that's commonly said in supply and demand space trading. And the confirmation entry is pretty simple. It's simply you have your, let's go down here. You have your high time frame zone, right? Price is going down, and then we trade into it, right? And once we tap into it, I'll just remove this. So say this is the higher time frame, price is tapped into it. Once we tap into it, you drop to the lower time frame, and let's say for example, I'll just do it in here. Let's say for example, price is making higher highs and higher lows. What you would do, I'll make it a bit there we go. Okay, so what you would do is, when price is approaching your zone, drop to low time frame and look for that breaker structure. Okay, so as you can see, price broke structure here, so that's the market's potentially turning point on the lower time frame. So what we can expect from there is for the higher time frames to follow, and then eventually, right, for example, let's say it's the H4 low, the H4 low will get taken, right? Or say this is the daily, and then say for example with the H4 low will get taken. So you took the trade based off that lower time frame with the anticipation that the higher time frames will swiftly follow. So it's sort of like, I'm trying to think of an example to think of, but it is pretty simple. There's no need to overcomplicate it. But yeah, that's pretty much why, if you understand the fractal nature of the market, it's actually a very sort of powerful thing to know. Because when we look at those trades, like I said, from higher time frame zones, it's very important to look for those confirmation entries, because when price is trading into it, right, we're still moving bullish. So say we have a zone here and we have a zone here, right? This is the best thing. I'll explain more about the concept that we use. in terms of like wins and losses and things. So you can have like, you know, many zones from here. Let's say for example you got 3 zones that you're looking to trade from. You don't know which one price is going to react to, but you're just going to look for a confirmation entry. Okay, so what you do is you wait for price to tap into it, and then obviously you look for local time confirmation entry. And usually a lot of the time, if it's not the correct zone, there will be no confirmation entry. And like I said, remember what confirmation entry is? It's that break a structure on a lower time frame. Okay, so usually if it's not the right zone, price won't react to it. It'll just break above. So for that reason, we wouldn't take a trade off that zone, because we would look for that lower time frame confirmation entry, and without it there is no trade. So if price obviously continue to rally above that zone, but then that's not the right zone, so what we do is move on to the next zone. Okay, because like I said, we're following the overall higher time frame order flow, and we want to be selling, and we can go ahead and, you know, mark out these points here, for example, like there and this low. And the reason why I'm marking out that is simply so you can keep track of your highs and lows. This is what I do, is I have my time frames marked up. If I just pull this up, you can see the templates are pretty simple. I have the daily highs, daily lows, and that way I know where price is, you know, tapping into. It's tapping into the daily highs, right? And if we were obviously, you know, the reason why this is the daily highs is obviously because this is also a lower high. So I measure the lower high to the lower low, and obviously a bearish market and a higher high to the higher low in the bullish market, right? But the reason why we mark out this is because this could be considered the last point of supply, because if price was to break above this, well then, like I said, we'd have that anticipation of price heading to potentially bullish market from there, right? So if we can have this last point of supply and our zones are near the last point of supply, well then there's a higher probability of price reacting to that zone. But like I said, price can react to zones around here, right? Around here. You just got to understand and react to which, you know, what's going on in price. But like I said, you know, this zone that we previously had on here, it got violated, so you move on to the next zone, okay, which would be here, and then price taps into it, get a bit of a pullback, but there is no lower time frame breaker structure to the downside, right? So like what I said is price continues bullish. Yeah, we got a short-term pullback, but there was no breaker structure, so there is no trade. So we look on the next zone, then price taps into it, and what do we see? Well, if we just take a quick look in here, we can see that price tapped into this zone. We're near the last point of supply, you know, daily high. You know, we can mark up our discount and premium, but as you can see, you know, we're well into the premium at this point. And this is another thing you can do if you haven't learned this before, is if you want to look at zones and you have a zone here, you can sometimes, if you want to use this discounted premium, that way you can know you're always getting the best, you know, the most premium deal, especially in a bearish market, and the best discounted deal in a bullish market, right? But yeah, let's just continue on with what we're doing. So let's say, for example, price just tapped into the zone here. Okay, if I just redo that so I can clear it. So price tapped into the zone here. As you can see, we look, you know, drop to the lower time frame. So the daily time frame, we can just mark out the daily time frame zone, and wait for the daily time frame to tap into it, right? Once it taps into it, that's when you drop to lower time frame. So you can ignore the lower time frame until price reaches this area, right? Because sometimes what you will see is price will slightly, you know, get a reaction, but you know, just a tiny bit below. So what I like to do is just add on a few pips when I'm setting an alert, especially if it's a higher time frame, then obviously I drop it quite a lot. But if it's a lower time frame, then I'll just have it a few pips, just because sometimes, you know, if there's an imbalance between, let's say here, it will just fill the imbalance before, you know, going. But yeah, you know, say price is tapped into this zone here. What do? We drop to the lower time frame. And as you can see, the 15-minute, I can't do that. The 15-minute is obviously this red one. As you can see, what did price do? It came back, put in a new high in the market. Then what happened is price come back down, put in a new low in the market. So at this point, we can class this as a chuck, which would obviously we'd have a bearish intent. And in this example, and the reason why I say bearish intent is because it's not a confirmed trend. In order for there to be a confirmed trend, you need to have at least so say for example, price was, you know, previously bullish, right, whatever, right? Okay, there we go. So say for example, price was probably I don't think I will. But as you can see, right, price was obviously previously bullish. We're putting in, whatever in the market, high, low, high, low. Then what happened in prices? Yes, we got in a new high, but then we took out this low. Right, now it depends how you class your breaker structures. I look for body closures on the candles, and that's the only way I recommend it personally, right? But as you can see, we have took out this low. Now this low, once it's been taken, we can expect it for to continue bearish. And obviously once price comes back and taps into a zone and adds that confirmation on break structure again, that point there on a second breaker structure, that becomes a confirmed trend. So this first breaker structure is unconfirmed, right? This second breaker structure is confirmed because we've put in 2 new lows in the markets, right? So it's pretty basic concepts. But yeah, the reason why it's confirmed and unconfirmed and whatnot, you don't have to call it that, it's just how it works. But the reason why for that is because when price takes out the first low, it could just be a liquidity sweep, right? Now that especially smart money concepts are getting more mainstream, a lot of people are gonna for example buy from demand here, have a lot of liquidity to the below this low, and then obviously that would cause this breaker structure. And once the breaker structures happen, we can expect a pullback, and we can look back in here, we can add in some confirmations like the fib tool, discount premium, momentum and stuff like that, and you can mark out your zone, right? That's when we switch to lower time frame, look for a lower time frame trade. Now this trade, I'd say it's more of an optional entry. It doesn't matter, it's up to you if you take this. Like I said, this is slightly lower probability than taking one from here. And the reason why this is slightly lower probability is simply because obviously in terms of probabilities, this one has more stacked odds, because obviously we've got the second breaker structure, which was confirmed that new trend. So yeah, just get rid of all that. So yeah, the first price break and price point is obviously a what we call chock, and that's just simply called a change character. I just have it labeled CH, as you can see. And then obviously the second one is BOS, so breaker structure. But as you can see, right, going back to the fractal nature of the markets, price took at a 50-minute low, but then create a new zone, let's say around here. Obviously that would be, we'd look on obviously a real price chart, but this is an example. But let's say you got a zone here. It's up to you whether you want to take this trade. That's absolutely fine if you want to. Your stops above there. That's still on target the lows, let's say. That's still at 2.45%. Or what you should do really in this case is probably target the daily lows. That way you can obviously you're riding the overall higher time frame direction, but you're getting in on a lower time frame. And this is how you can sort of once price takes out that daily low, yes, we can expect a pullback, but you can start to manage your your trade on the higher time frames. So for example, if you manage your trade on a 5-minute, you look for the you just manage it in terms of structure. You can eventually flip to the 15-minute and to the 30-minute and to the 1 hour and to the 4 hour and then eventually the daily, right? That way that short-term, well, not short-term trade, but that lower time frame trade has turned into a huge swing trade, and you only have, let's say a 5 pip stop, right? You only have a 5 pip stop, and that huge trade is, that low time frame trade is now gone into a huge trade, right? With potentially huge risk reward. But yeah, there's so many opportunities, but you just first need to understand that the fractal nature of the market, it simply moves like this. And then obviously from there, what the price do? It came back down, putting a new low in the market, and that would be our confirmed trend. So any pullback after that is what we'd look to trade from. So let's say even if price come back up here, we'd look for a zone trade off there, and or wherever the zone is, or wherever you look for that lower time frame entry. Because you can look at this as a 15-minute zone, and then you can look for a 1-minute entry, and then you go to the 1 minute, and then you use the fractal nature of the 1 minute time frame, right? And then you can target the 5-minute lows, anticipating that the 5-minute low will be taken out, and then the 15-minute low once that 5 minutes taken out, and then the 30. That's how you eventually scale at the time frames, okay? But yeah, hopefully you've learned something new in this video. I honestly didn't know what to call it. I will show you a quick example on the real time frame in a minute. But I didn't really know what to call this video, just simply because it was more of like a quick video that I was thrown together that I thought I'd explain some things that I found, valuable. That I feel like, things that needed to be cleared up. So I guess it's sort of just a free flow video. But yeah, hopefully you gain some value in this. And now I just want to show you a quick example of chart. Right, now I'm just going to stay on the daily time frame. I'll go on probably on a 4H as well. So what I'll do is just Put that there. Now, as you can see, right, price was obviously previously bullish, moving to the upside, and then obviously in terms of higher highs and higher lows, price took out this low, right? We even took out obviously this major low, and obviously we can look at that as a chalk, right, or a double breaking structure, whatever, and that would be quite, you know, a big trade. Now, as you can see, price didn't really react and come back up here. We reacted to this sort of wick, which acts as a sort of, you know, a breaker, and that's still valid, valid. And then from there, obviously you got this range, you got the low, got the high, and then obviously price made a short-term pullback, you know, a buy to sell, put in a new low, and this is the new low, right? Now, in terms of extreme highs and lows, you got this low and this high, right? And a lot of people, they'd look at this, you know, probably look to trade from here. But like I said, if you're one of those people, like we've spoken about a minute ago on looking at zones, if you had a zone here and a zone here, well then, you know, you can still look at the zone, you know, on a smaller time frame, and I can almost guarantee that there is no reaction from there on the lower time frame, right? And you can see it in the wicks price. I mean, we tapped into this equal high, but from that point, that would be like a break above the actual order block, and you had the short-term reaction, but there was no sort of breaker structure, no bearish candle, no nothing reaction, right? And then obviously price came back up here, formed, you know, whatever, and then obviously that's when we start to sell off and put in new lows. Now, if we just focus on this bit of price action, you can see we have a daily zone here, which is just refined to the wicks, because as we know, wicks can act as a hidden supply demand zone, and obviously this is our sort of, you know, we're on daily, so it'd be the daily high, and obviously this is the daily low down here somewhere, or here, sorry. So we have that probability of price, you know, obviously reversing. So what we can do, once price taps into this zone, right, go to the 4 hour, see price creating higher highs and higher lows, and we can start to identify them and, you know, mark them in the markets. And then what happened from there is price came back down, and if we just mark this low, we wick the lows, but that wouldn't be a trade to me just yet, because I don't class that as my breaking structure, because like I said, I use body closures. So we'd class this as your breaker structure, and then obviously what we do is we mark up, you know, high to the low, have the magnet on so it kind of sticks to it, and then obviously we want to be buying anywhere within this zone, because that is our premium zone. So what we can do is we can either take this as a wick, as a hidden supply demand zone, whilst in this case supply, and then what we do from there is we'll drop to the lower time frame and look for a confirmation entry, right? And then we just, you know, continue to do this until eventually we get in on a trade. And you know, when in terms of like pulling the plug, you know, just buying a bullet and taking a trade, just take the trade, right? Win or lose, it doesn't matter the outcome, there's no emotions involved, just come back and try again on the next zone. I just wanted to mention, as I completely forgot. Now, obviously we was on a day time frame, we tapped into this daily zone, and then obviously we broke structure on a 4 hour time frame, which is what we're on now. Then obviously once price comes back and tapped into its wick, that's when we drop to the low time frames. Now you can use whatever time frame you want. We've already used the 4 hour, you know, if you want to go to the 1 hour, you can just look at some, you know, see what's going on in price. You can refine zones if necessary, but I'm happy with the zone. As you can see, this is the big one, but we could also just go ahead and make those minor refinements in terms of like, okay, refine it to this sort of candle, you know, and this could be the equilibrium for this candle, right? And then it's up to you what you do from there. You can go to the 15 minute or the 5 minute. What I like to do is I like to use the 5 minute personally, but you'll see the price is pretty similar on a 5 minute and a 15 minute. And then obviously once you go on a 5 minute time frame, this is what we look at, okay? Now I'll explain some things here as well, so make sure to listen up. So obviously in terms of highs and lows, you know, we can go back and look at this low, put in this high, and obviously we got this low. My screen's quite laggy, I'm not too sure why. So we got a low and we got a high, okay, breaker structure, okay. Now this is the low that we want to see taken out in order to sell, okay. So sort of like a lock. If it's not taken, then we don't take it, because a lot of the time price could just come back down, wick it, and then continue bullish. That's why I don't really like wicks as my breaker structure. But as you can see, right, price didn't take it out here, but we took it out here, okay. So in terms of ranges, we sort of have this sort of, you know, whatever. But if we go back and look at the zones in which we're looking at, we can start from this high, right, in zones we're looking to trade from. And you can see that we have this zone here, right? Now, I wouldn't choose this zone for a few reasons. That first reason is simply being that it's very high in price, and obviously BFIs, they need to push price up, so it's more of a hassle to do so once we're this low in price. So I probably wouldn't choose that zone based off that as well. But also, the way I look at it as well is, in order for there to be a valid order block, you must understand that there needs to be an imbalance in a breaker structure. Okay, so if we look at this as in terms of an imbalance, yes, we have a huge imbalance here, right? But as you can see, we've already come back and filled it, so we've already seen that buy move, right? If that makes sense. Hopefully that makes sense. So there's that imbalance, but it was already taken, right? Price already put, BFIs have already pushed price into that imbalance area, which is already that, that liquidity or whatever. That has all been taken now. Okay. Yes, they're only tagged into the midpoint, but if they really wanted to, they can push price all the way up here before moving down. Okay. But they've collected liquidity and prices run. And there's a few other things you can do. You can measure the move from there. As you can see, that's a 12 pip move. Then if we measure it from here, you can see that is a 18 pip move. So you can measure the moves in terms of the reactions from the order blocks, and sometimes that will help you in identifying LBs and things like that. It's just the little things you want to try and stack up, because at the end of the day, it's all about probabilities. Okay, so I'll choose this zone. I probably wouldn't choose this zone just simply because of the way it is. If we were to drop this premium discount, it probably will just make it. It made it a little bit here, and there's this imbalance here. But again, price has already took it here, right? This one hasn't been taken just yet. This is still, fresh. Price hasn't even tapped into this area. Not even these wicks are pushed past the previous wicks, but this imbalance has. So it's the same story as this one. So that would be the more probable one. And this is obviously, it seems to be like the midpoint of the range. No, it doesn't. Okay, this is the midpoint of the range. But in terms of the whole range, you can see that this barely makes it. Okay. So I probably wouldn't trade from there. Like I said, you can look for a 1 minute reaction from there, but even on a 5 minute, there was no breaker structure below this low here from this mitigation here. So we look at this one, and as you can see, price is tapped into it. Now this is the point where you can either take the trade, or you can drop to the 1 minute and look for another opportunity from there, right? But you can take a sell from there based off this bearish candle or the mitigation, whatever. And that's another thing you can add as well as confirmation, is look at the candles, right? As you can see, the candle here is closed below the previous bullish candle, and also it's left a huge wick to the upside and barely no wick to the downside. But what I probably would do is just draw up this and look to take the trade. Now, as you can see, price is already pulled back into that. And I would go to the 1 minute time frame, but it kicks me out the 1 minute time frame because I'm back so far in data. So unfortunately I can't do that, which is really frustrating. I wish I really could, but based off looking at this sort of two candles here, you can already tell that this is a 1 minute breaker structure below this wick low, and this here, there's an order block sat in this wick, even on a 15-second time frame, whatever, and prices come back and mitigate this wick. So you could take a 1 minute entry based off this zone, and I can almost guarantee, not guarantee it obviously, because obviously I can't predict anything, but I'm pretty certain that there will be a 1 minute reaction from there. Okay, then obviously price just sort of continue to range, sell off, whatever, and then we see next explosive move to the upside. Just looks like a sort of sell trap. We didn't take out the stops, so if you move your stops to break even, you probably would have stopped out break even. But why not take the re-entry? So price came back down, broken structure, buy zone again. You'd look at 1 minute entries, whatever. As you can see, bearish candle. This is a huge candle, so what I'll probably look at is just again try and look for a break below these sort of candle lows here. Once price has done that, obviously it sort of did. We did get a wick, we didn't close below it, but you can look at this candle here and you see that prices eventually closed below it. So what you can look at now is potentially again this wick, and that would be your entry based off the bearish candle. Didn't really close below this bearish candle here. This is an extremely bullish candle, and then obviously we had this bearish. We broke, came back up and sort of mitigated this sort of wick area. So I'd probably look for 1 minute entry in here somewhere, as I'm sure you'd get it, especially looking at this price action here. It looks like a break and retest sort of style. But yeah, I'm just trying to show you pretty much what to do, explain the why behind the fractal nature of the markets, because what we got to remember, even though we're taking these trades, is that we're dealing with, if we go back to this example, right, remember what we just saw in that little price action there, okay? we're dealing what's going on here. So even if price ranges for a bit, we can eventually, expect it to sell off. So once we're in the trade and price doesn't come back to break even, it just starts to melt, and we put in, new structural ranges to the downside, especially in this example. And then we can look to target the low and look to manage the trade, and that'd be the right zone, obviously, that you took the trade from. Okay. But a lot of time, I think, like, if we remember, I've spoken about fear and greed. They're your worst enemy, and I 100% back that. The reason for that is because a lot of people, they take the trade, the first trade, they get stopped out. I've done a post on Instagram about this, so if you check the post from the 15th of January 22, it'll be there. And pretty much what I'm relating to is, who cares about losing -1%, -1%, -1%, 3 trades in a row, whether that's spaced out over the few days, and then the 4th trade is, a huge 1 to 10 trade, or a 1 to 5, because you got the right zone eventually, right? The first 3 tries, you just weren't on the right, you just didn't get the right zone. You're just a little bit too early on the market, and then you come back on the 4th trade, and that's your winning trade. But a lot of people wouldn't come back and take that 4th trade, because those 3 losses, even after the first loss or the second or third loss, whatever, a lot of people wouldn't take those, that 4th trade especially, or more trades, just simply because that when you take the loss like that, the mind will boggle you as a trader onto, okay, you shouldn't enter this next trade. But in reality, I think sometimes you need to just bite the bullet, and this is why I heavily relate to, when I think about that, psychology is heavily involved in trading. It's the number one key thing to understand, because I can show you, I can feed, lead a horse to a river to show him the water to drink from, but I can't physically make the horse drink water. If it doesn't want to, it doesn't want to. So what I relate to that in terms of the markets is that someone can show you how to trade and show you a systematic approach to the markets, and show you, how to do things, and show you everything that you need to know. But it's up to you as a trader. Psychology and things like that will develop over time. I can only share my experiences and share my losses and lessons that I've learned over the time, my failures and setbacks, and that will only help you avoid potentially things that I've explained. But you will face things like losses, failure. Losses are inevitable. That's fine. Especially if you're an upcoming entrepreneur, there's going to be many setbacks, there's going to be many failures, and your success is around the corner, just quite frankly. But you just got to keep on pushing through the bad days. If you don't, you can't hack the bad days, you don't deserve the good days. So just keep on pushing through, and So thank you for so much watching. I really appreciate you guys. If there's any questions, make sure you ask me, and I really hope that there has been some value in here somewhere.